Today, we're unpacking one of the most consequential energy stories of early 2026 and why commodity markets need to treat it as an energy supply story, not just a political headline. On January 3rd, 2026, U.S. forces captured Nicolás Maduro, Venezuela's de facto ruler, ending more than a decade in which he retained control despite elections widely rejected by international observers. Venezuela holds roughly 300 billion barrels of proven crude reserves, among the largest in the world, yet its oil output remains a fraction of that potential after years of institutional decay, underinvestment, and sanctions. Today, we're breaking down what this means for oil prices, energy costs, and downstream commodity markets, including the recycling and metal sector in 2026 and beyond. Venezuela's role in global oil markets has collapsed over the past 2 decades. Once producing more than 3 million barrels per day, output in recent years has hovered around 800,000 to 1.1 million barrels per day, less than 1% of global supply, despite its enormous resource base. Rebuilding that capacity will not be quick. Analysts consistently warn that lifting output meaningfully would require years of political stability and tens of billions of dollars in investments, even under favorable conditions. That reality explains why, despite the political shock, oil markets have reacted cautiously. In the days following Maduro's capture, oil prices moved but modestly. Brent crude initially rose on uncertainty, then retreated as traders refocused on fundamentals. Markets continued to price in ample global supply, not scarcity. The oil market entered 2026 with a structural surplus. U.S. shale production remains resilient. OPEC has begun unwinding earlier output cuts. Russian crude continues reaching markets through alternative trade channels. Estimates put global oversupply at roughly 2 to 3 million barrels per day. In that context, Venezuela's current production level simply lacks the weight to move prices dramatically in the short term. There's another important development shaping expectations. U.S. policy has shifted toward allowing continued Venezuelan oil exports, including flows to U.S. refiners. These arrangements could redirect tens of millions of barrels that previously moved to Asia, adding incremental supply to already well-supplied markets. This reinforces a key point. Venezuela's story does not create an immediate supply shock. It adds to medium-term supply optionality. Even with policy changes, Venezuela's oil sector remains deeply impaired. Much of the country's infrastructure is in severe despair. Only limited upgrading capacity is operational. Storage, pipelines, and processing facilities have suffered years of neglect. This means that even optimistic recovery scenarios assume a slow, uneven rebuild, not a rapid return to former production levels. Markets understand this, which is why price reactions remain restrained. So how should markets frame Venezuela now? Short term, 2026, oil prices remain anchored by oversupply. Major forecasters continue to see Brent averaging in the mid $50 per barrel, with downside risk if supply remains abundant. Medium term, late 2020s, if Venezuela stabilizes politically and attracts sustained investment, output could rise gradually. And modest recovery towards 1.3 to 1.5 million barrels per day over several years, potentially higher levels later in the decade under favorable conditions. That incremental supply could cap future oil price rallies, especially in a world already rich in barrels. This is where energy markets intersect with metals and recycling. Energy costs are embedded throughout the industrial chain. Diesel for collection, transport, and freight. Electricity for shredding, processing, and melting. Fuel and power costs for steel and aluminum production. In the United States, roughly 70% of steel is produced in electric arc furnaces, making power prices a central input cost. If additional oil supply helps keep energy prices structurally lower over time, the downstream effects are predictable. Lower freight and logistics costs, lower melt and processing costs, greater pressure on raw material spreads as mills defend margins. For scrap markets, that often means tighter buy spreads, even if overall industrial demand improves. Rather than reacting to headlines, market participants should track concrete signals, medium-term oil price curves, not daily spot moves, evidence of real capital commitments in Venezuela, export volumes and refinery intake trends, regional diesel and electricity pricing, mill booking behavior and lead times. These indicators will determine how Venezuela's situation actually feeds into energy and commodity pricing. The capture of Nicolás Maduro is a significant political event, but for energy and commodity markets, its impact is indirect and structural, not immediate. Short-term oil price volatility remains limited. The bigger story is how Venezuela re-enters or fails to re-enter global supply over time. For energy, metals, and recycling markets, the implications will unfold over years, not days. Underestimating that timeline is the difference between reacting late and positioning early. For ongoing coverage of global energy markets, visit OilMonster.com. For downstream metals and recycling market intelligence, follow ScrapMonster.com, where macro energy trends meet real world pricing. Thanks for watching.